Hi, I'm Roger Montgomery from the Montgomery Fund, and I'm joined by Ben McNevin and Russell Muldoon. We're going to bring to you today a new video, the first of a number of videos throughout the year called Like It or Not. And we're simply going to go through a bunch of stocks in rapid fire fashion and find out why we like them or don't like them right now. So starting with you, Russ, Challenger, like it or not?
So Challenger, we currently really like Challenger at the moment. It's our number one position in our funds. It's got growth coming from three potential avenues which are material. First is the amount of assets moving from wealth accumulation phase into pension phase is forecast to quadruple from 66 billion, a factor of 4 times over the next decade. That's a huge beneficiary for them. The second one is the amount of potential assets moving into annuities, currently sitting around 4% of the total market, likely to grow to 10 to 15% over the same time frame. And the third is the financial stability inquiry chaired by David Murray at the moment, who's looking at longevity risk within pension phase for Australia's, when most of Australians and baby boomers move into decumulation phase. They're thinking about mandating a certain level of retirement assets and pension assets that have to be within annuities. So there's three very, very strong structural growth avenues which are going to persist over the next sort of 10 to 20 years. And the advantage of, with a recent share price correction, we think it's very cheap.
Thanks for that, Russ. And Ben, JB Hi-Fi, the retail sector's on the nose. What do you think now that the share price has dropped so much?
Roger, we don't like JB Hi-Fi at this level, and we actually sold before the price fell away. We felt that the operating leverage of the business had left it quite exposed to a weakening sales outlook. And so if you've got rising staff costs, rising rent costs, and yet the sales just weren't stacking up, we felt it was quite a risk holding this company, particularly if it was dependent on Christmas sales to get it across the line. So we're very comfortable being on the sidelines at this point.
Okay, Ben, great, thanks for that. Turning from retail to healthcare, Russ, Certex.
We definitely like Certex, and it's our number 2 position within our funds. Most people don't know that just recently ESMO, which is the European Society of Medical Oncologists, just put SIRS fees on the treatment guidelines in the entire Europe for the salvage setting. So when people become chemo refractory, SIRS fees are now best practice for oncologists in Europe. We think that's a fantastic development for the business, and unfortunately the company hasn't made an announcement to the market, but we picked up on it by following media releases. We also think the potential for Certex, if they can move their treatment from the salvage setting into the first line setting, and they have a huge trial underway at the moment by the name of Surflox. If that proves as effective as it has been in the salvage setting to the first line setting, it's going to open a huge market for them. So the share price today could be $50, $100 in 5 to 10 years' time.
And from one high flyer to flights of a different kind, Ben, Flight Centre. What do we think of Flight Centre now the share price has dropped?
Roger, we love Flight Centre long term. Fortunately, the share price has come under pressure in the short term because of several temporary issues such as the Ebola crisis and the weakening Australian dollar. But we know that people will get better again, and we know that the outbound travel is more driven by price flights rather than the Australian dollar itself. And for management to come out and say we've got a plan out to 2035 and we want to be around for that to see it through to completion, it's great confidence in the company and the board. So we do love Flight Centre for the long term.
Thanks for that, Ben. And going back to another business that I know we've liked for a long time, Seek, Russ. What do you think of Seek right now?
We still like Seek. We've held Seek for a long time. We did recently sell about half of our holding when the share price was $17.50 when we thought the shares were a little bit expensive. We still see some good opportunities in Australia. They've got about 70% of the revenue of online classifieds and about 90% of the activity, but they only have about 22% of the opportunity set in front of them for job placements, which is where their key focus is. So we do see some pretty exciting opportunities for growth for Seek to come in placements in Australia. But offshore is probably where the focus is for a lot of analysts, and including us at the moment. They have number 1 websites in markets such as Asia and Brazil, for example. These markets encompass about 20% in addition to Australia in terms of world GDP. So there's some very exciting growth opportunities over there. We just thought the share price had got ahead of itself by a little bit.
Thanks for that, Russ. And finally, turning to another online list, instead of a list of jobs, a list of cars. We recently sold out of car sales. What do we think now that its share price has dropped, Ben?
Car sales we like, it's one of the best companies on the ASX, but with every investment, price must come into the valuation, and we felt the price was just a bit too ahead of itself. So we were cautious that there was a lot baked into the international prospects, and we're also worried that dealers may not respond as favourably to car sales' recent acquisition of Stratton Finance, and we're also cautious that the listings were rather subdued of late. So for now, we very much like car sales, and we look forward to getting back into the company when the share price hopefully retraces further. But for now, we think the share price went a bit too far.
So there you have it, some quick thoughts from Montgomery Investment Management and the Montgomery Fund on 6 stocks that you might want to research further. We look forward to seeing you again next week.